I'm J.R. Gondeck. I'm joined, as always, by David Sokolovsky. David, let's look, recap the month of May. This record is a little bit different. We have a little fun look back to kind of our first stock screen 50 years ago toward the end, maybe some of the lessons learned and maybe some of the things to look forward to ahead. So David, let's look at the month of May.
Yeah, Joe. So recapping the month of May and maybe even the first, couple of days in June. And really, the S&P continues to be the story for the year and for the month as well. So in the month of May, the S&P was up nearly 5%, really recovering all of April's losses. And then small cap stocks turned positive again for the year. And the reason why I bring that up is because there's been a lot of excitement about the S&P and some of the large cap names, but people forget that as recently as last month, some of the small cap names have been negative. But if you look at where things are, large cap really continues to be the best performer for the month and for the year. And another interesting thing to note is value outperformed growth for the third consecutive month, with the exception again of large cap. And the S&P is now up in double digits, while small cap has, like I said, barely turned positive. So it really is a mixed economy, a mixed market, where you're seeing some companies and some stocks that have benefited and some that have continued to struggle. And if you dig into some of the sectors, energy and financials are still doing well. Utilities remains one of the best sectors for the year. And then when you look over to the bond side of things, bond market again still negative for the year, but the 10-year has seen yields come down a little bit through May, and then a little bit into the start of June. So you've seen the 10-year rate drop to below 430
And
some trading days.
And David, when you look at the last 18 months or so, a lot of the focus in the markets have been in the large cap growth, technology, the AI trend that's unfolding, and a lot of the companies have benefited. But I think it's good to look back maybe at the last 2.5 years, comparing value to growth, and kind of see the volatility you get within each asset class, and then maybe a look to kind of how returns have been during those two different periods.
Yeah, Jared. So, Gene used to say this quite a bit. The starting point and the ending point are very important. Tell me which starting point and ending point you want to use, and I'll let you know which index would have performed the best. But to kind of highlight your point, if you look back over the last couple of years, and really if you look at the performance, in 2022, you had all of the growth segments down, somewhere between a third of their total value and 24%. So large cap being down a third, mid cap performing slightly better, small cap down nearly 29%, and then developed markets being the best at, only losing a quarter of your total portfolio value. But let's then play that out over the course of the following year and a half. You had a strong 2023, large cap, mid and small somewhere in the middle. And then year to date, large again continues to be the best, mid and small no longer the best. We talked about small cap not performing as well and just turning positive. And then developed markets, up 7%. But what does that mean for you over the course of a 2-year period? It means that in large cap, it would have been the only place you would have made money on the growth side of things. Everywhere else, mid and small and international, you would have lost. On the other hand, if you look at the less exciting value sector, over that same 2.5 year period, or 1.5 year period, you would have, really been positive in all of the sectors, large outperforming growth even, but, across every segment, you've outperformed, and in many cases, you're still positive. So up 2 is better than down 10 on mid cap. Up 5 is better than up 11 on small. And up 11, obviously outperforming down nearly 6 on developed markets. And that creates the case, Jeff, for some of the diversification and really, focusing on areas outside of growth, because it hasn't been, a one-directional market across the board.
Well, one question we're getting a lot of too, David, is this a new era, right? You look at the last 18 months, this AI movement, the movement into big tech. large cap growth overall. Should you just have your whole portfolio there? That's what's worked. Should you continue to overweight? You've seen a lot of action and movement generally, right? And it's been a big challenge overall, but I think it's good to look back at different asset classes over time, how things have fluctuated, keep things in context. That I think that value versus growth, it's kind of the story of the turtle wins the race, especially when you're in retirement. Yes, you want to have the opportunity to benefit from the growth, but you never know when that big downturn in the market will go. And you can see that in general, there's a lot more volatility and growth versus kind of being balanced in your overall portfolio. So when you look maybe at history of asset classes, you always have this periodic table sort of speak of look of asset classes. Again, I just think it's a reminder over time. It's hard to see this, but in general, when you look into the graph, from year to year, things fluctuate. There's no asset class that's number one every single year or the worst every single year. And when you get periods of momentum where we are at this point in the markets, it's easy to think you can't lose money in a lot of the growth, and you want to sort of over allocate or move the majority of your portfolio where things are moving and doing the best. On the other hand, as a reminder, the two biggest points within the markets that are difficult from a long-term investing standpoint are at or near the top of the market and at or near the bottom of the market. And both could be traumatic from your long-term planning or portfolio perspective. If you get too conservative or get spooked out at the bottom of the market, when things recover, you miss out. And at the top of the market, it can be equally challenging that if you over allocate to what's really, really done well, that's been volatile to the upside, if and when that trend changes, it's hard to reallocate fast enough. And I think it's a good reminder. There was an article out in Bloomberg, over the last week or so, talking about a bear market in diversification. And really what it's referring to is if you've been in the S&P or heavily large cap growth, that's done the best. Diversifying anything away from that has brought down your rate of return. On the other hand, when you look at longer term results and managing volatility and really protecting your downside, it still is an important consideration as you're looking at your portfolio. Be mindful, right? And our sense is you still want to lean into where the growth is and where the action is. On the other hand, it doesn't mean you should sell everything else in your portfolio that isn't doing nearly as well. They'll have their day in time, and it's a key. It's one thing I've said over the years. We're not going to get it right every time. We're going to get it right over time by adjusting, staying current with the trends, and rebalancing, at different points of time in the market.
So Jared, talking about the market, one of the bigger inputs and driving components, of the market, is the overall health of the economy, the overall health of the consumer, and kind of the direction overall. So what are you seeing in terms of economic growth, development, areas of weakness, and potential opportunity?
Well, when you look in general, we're always looking at kind of that big picture question, as you said, David. Where's the economy at this point, and more importantly, where is it going looking forward, right? And that's always a good guide as to should you in general be taking on a little more risk within your portfolio, should be a little more conservative. And when you look at the GDP graph that we're looking at here, there is no let up in the GDP. We're at an all-time record high, whether it's adjusted for inflation, which is the dashed line, or if you look at nominal terms, it's been a great period of economic growth, the largest in the history of America. And again, more importantly, looking ahead, you sort of had that April effect from the standpoint of the slowdown in the economy. And it seems to have bounced back in the month of May. So when you look over the period, we had 2 quarters of negative growth in 2022 overall. And again, was the big shrinkage in stock prices, especially in the growth side during that year. But looking ahead, we still seem to be in that sort of Goldilocks scenario of growth where it's not too strong, it's not too weak, and we're coming off a great period of growth. I mean, our base case as you look forward is growth should remain steady, at this point. And from, where to adjust your portfolio, it's a matter of finding those opportunities and leaning in. But at this point, the economic growth remains steady, and really the focus now is going to be on inflation and the labor markets overall.
Yeah, talking about inflation and labor markets, we can start with Inflation first, since that was the most, recent kind of data point that we received, but, a significant improvement from what we've seen in the last couple months. So we've seen headline CPI, which is the price for all goods and services, come in unchanged from the previous month. And that gives the Federal Reserve some breathing room on their interest rate policy. But you've also seen producer price indexes, the producer price index come down this month. And I think what that highlights is what that means for future inflation. So producer prices being lower indicates that the cost of goods looking ahead will likely not increase as well because the inputs to those products is less than what it was. But if you look at this graph, this is the most recent reading in the month of May. You've seen that May of last year rolled off, and this was a big concern for the Federal Reserve and for the economy overall, because if you look at the last couple months, January was up 0.3, February was up 0.4, March was up 0.4, and April was up 0.3. So those are some pretty strong readings. And the concern was that if a 0.1 rolls off and is replaced with a larger number, then inflation will continue to accelerate. But what you're seeing here is inflation is starting to slowly improve, and there's opportunity for further improvement in the next couple months, particularly in the months of August and September.
And there's good reason, David, to believe that the trend unfolding is likely to sustain those 3 and 4 tenths. For the most part, I feel like they could be rear view mirror looking at this point. I mean, you look at some of the data points, in a lot of the retail stores, they're lowering prices on a lot of the goods. You've seen airline ticket prices come down. Really, the two sticky components, at this point are in shelter and service inflation. But the majority of other things seem to be easing, and shelter at this point, rent has leveled off. As we look ahead, you could start to see shelter finally, come closer to where it's been over time. And you could see CPI continue to be in that unchanged to 2/10 range for the foreseeable future. And again, from the Federal Reserve standpoint, they really want to look at the labor market now too. When you go back to the jobs number from last Friday, its headline looks pretty good, doesn't it, David? But again, when you look at the household survey, it tells a little bit different story as well.
Yeah, Jared. So there's two ways that labor is measured. One is through direct polling of the employers, and through their payrolls. One is through the household survey. And so the scientific approach and the method raise some questions, because again, to the viewers of this, who received a phone call and what was the question that that you answered essentially when asked if you were looking for a job. Many of those calls go unanswered, and so a lot of data is lost. But typically, you expect to see some movement in at least in a similar direction. But to show 272,000 jobs created with payroll companies, and fewer households being employed, really just shows that there's the opportunity, or at least the perception of people picking up that second and potentially third job in the face of higher costs, and to combat some of that rising inflation. So on one hand, you have people taking on new jobs. On the other hand, that's concentrated in fewer households, and as a result, just really translates to more people, or fewer people working more jobs, potentially either part-time or not achieving that full employment. The third question that would be asked, as Gene used to always say, is the first question they ask you is, do you have a job? And so if you do, you're part of the labor force and are employed. The second question is, if you don't have a job, are you looking? So that's what determines the unemployment rate and the labor participation rate. And the third option is, as Gene used to always say, is, if you were offered a job, would you take one? Right. And so that's really the question of where and what kind of offers are people looking for? Are they holding out for a higher offer and not accepting? Are they not, are they potentially discouraged workers who are not participating in the labor force but may jump back in if the right opportunity comes up? Those are all questions, for us to answer. But at the moment, it seems like the consumer remains in relatively steady shape, has employment, is able to continue to spend, and we'll keep a close eye on labor, because that is ultimately the biggest or one of the biggest drivers of the financial markets as well.
Well, the other thing too, the Fed and other policymakers follow too is job quitters, right? And again, the reason is why would you want to track job quitters? In general, it's a good sign of a vigorous labor market. If I'm confident enough to quit my job because I know I can find a better opportunity, get a higher pay raise, right? That was a big trend over the last 2 years that there was a lot of job quitting. That's eased over the last number of months just because of the fact it's really not a vigorous labor market anymore. It remains very steady and a solid job market overall, but there are signs of a little bit of weakness, and that dispersion between the household and the headline, might indicate some of that. But again, this is going to be another key, part of the economy to watch for in the months ahead. Does labor start to level off and go negative, or to remain in this decent scenario we have been? If we do in this decent, right, the Fed is going to lean on inflation, economic growth to decide policy. And again, after the Federal Reserve meeting, they adjusted down their number of rate hikes. Looking forward, it was at 3, now it's maybe 1, potentially 2. But as Chairman Powell said, they're going to be very data dependent. If the data comes in to support more cuts, they will have more cuts. If the data doesn't, they will continue to push those out until it does. So it's really a tricky spot the Fed is in. But looking forward, to me, I still wouldn't be surprised if you get those 3 rate cuts if inflation remains to improve like it could. On the other hand, it's going to be month to month on how data supports policy going forward.
So Jared, we've talked a little bit about looking ahead and where markets may be heading, where the economy is, and some of the strength. Let's look backwards now that we're in 50 years of picking stocks. And so let's maybe take a step back, look in the rearview mirror, see some of the names that some of us recognize but haven't seen, as an operating company maybe in a couple of years, and kind of talk about, how markets have evolved, and maybe again making that case for diversification.
Well, David, it's fun. We have this stock screen on our wall in the office, and to me, it's fun to look back. Right, these were the top 6 companies, January 1st, 1974. Right, and if we were sitting having a conversation in 1974, there's no way you would forecast that these 6 companies wouldn't be at or near the top for the foreseeable future. At the time, it's funny to look back because a lot of these, obviously, technology made them obsolete and other things. But at the time, you had IBM, was sort of the large cap growth story of its time during that period of time. Largest company at the time was 35 billion was the market cap 50 years ago. You had AT&T, you had Exxon Mobil, Eastman Kodak, General Motors, and Sears. And then you fast forward, and what happened over the last 30 years, if you would have bought these top 6 companies and just held them, you would have lost all your money on 3 of them, right? Sears went bankrupt and is no longer here. General Motors went through bankruptcy, and Eastman Kodak went through bankruptcy, right? And then you look at IBM, which was the largest company. Today in the S&P, it's number 54. So it's still around, still a great large company. It's just been passed by over 50 companies in the last 50 years. And then you have Exxon, which oil remains very much in need, is still remain the top, was number 3, dropped a little bit. And then you have AT&T, which dropped all the way to number 69. So what does it mean today? I mean, you look at the top 6 companies, 5 or 6 companies today, you have Microsoft, Apple, NVIDIA, Amazon, Facebook, Meta. And as you think about today, I mean, all these are heavily in technology. Talking today, it's very unlikely to see 3 of these companies go bankrupt in the next 50 years. But again, you would have said the same thing a long time ago. So to us, it's just a matter of understanding, where the portfolios are, going back to that diversification. These are great companies today. There's no question. You want to hold majority of these in your portfolio. On the other hand, I think it's mindful timing to take some profit, rebalance, and stay diversified overall, because as the concentration risk we talked about in the beginning of large cap growth being so much in favor, right? This trend will continue kind of till it stops, as the old saying goes. And to us, looking back over 50 years, what do you learn? what you learn is no company stays number one, number two, number three, number four, number five over a long period of time. There's ebbs and flows in technology and other things over time. And it's just a good opportunity as a reminder to look at today's big winners within the economy and the markets, but then be mindful of long-term trends and adjustments over time. So with that, we want to thank you for tuning in this month, and we'll recap June ahead.
Thank you.